Welcome to Iron Financial, the explainer, where we help you forge a stronger portfolio and cut straight through the market weakness. I am your lead analyst, and today we are looking at an absolute heavy hitter in the telecommunications space. Okay, let's dive right into this. We're running a full-scale drill down on T-Mobile's Q1 2026 earnings report. Listen, this is a company that has aggressively positioned itself as the undisputed apex predator of the 5G era. They are making massive structural moves, integrating huge acquisitions like Sprint and now US Cellular, and frankly, they're throwing around some seriously heavy financial numbers that demand our immediate attention. And I'm the Market Skeptic. I'm here to represent you, the audience, and basically ask the tough questions. Because right now, let's be real, everyone in the financial media is looking at T-Mobile's insane market momentum and asking the obvious question: is this real steel, or is this just slick corporate spin? We really need to know if the foundation is actually as solid as management claims, or if retail investors are just getting caught up in the hype of a telecom giant that is simply buying its growth.
So that brings us right to the core of today's stress test. Solid steel or rusting core? You know, when you look past the flashy headlines, the massive marketing budgets, and the CEO taking victory laps on financial networks, you really have to challenge the underlying structural integrity of this telecom giant. We've seen historically how absolutely brutal the telecommunications industry can be, right? We've all watched legacy companies look totally indestructible on the outside, but underneath the surface they were bleeding cash, crumbling under the weight of massive debt loads, and just suffocating from the sheer cost of maintaining aging networks. So are there hidden cracks in T-Mobile's armor that everyday investors are completely missing as they chase this stock price higher and higher?
Look, I completely hear your skepticism, I really do. But let me hit back immediately with a staggering figure: $6.02 billion. Let that sink in for a second. That is the massive amount of capital T-Mobile returned to stockholders in Q1 2026 alone. Listen, you simply do not return over $6 billion in a single quarter. And by the way, that's made up of $4.9 billion in aggressive stock buybacks and $1.1 billion in dividends. You just don't do that if your core is rusting out from the inside. It's not mathematically possible. That $4.9 billion in buybacks, that's not just some corporate vanity metric. It shrinks the available float of shares on the open market, which mathematically increases the earnings per share for every single investor who holds on. It's management pulling out a megaphone and signaling to the entire market that they believe their own stock is drastically undervalued right now. That number, $6.02 billion, is undeniable hard proof of a rock-solid financial foundation. This is an engine generating massive, sustainable amounts of cash, period. All right, let's get into Section 1, Top-Line Steel, Revenue and Accounts. Okay, hold on. Before we completely buy into the foundation, we need to inspect the framework from the ground up to see if they are actually building a stronger base. Let's look at the actual top-line versus bottom-line numbers we're seeing right now. On one hand, we have top-line revenue hitting $23.1 billion, which, is up an impressive 10.6%. But I have to aggressively point out the bottom-line net income here. It is sitting at $2.5 billion, which is down 15% year over year. As an investor, this rings massive alarm bells. I demand to know why a company that is growing its top-line revenue by double digits is simultaneously bleeding net income at an accelerated rate. Where exactly is the money going? Is this massive revenue growth just a top-line vanity project while the underlying business slowly rots?
Fair point. We will absolutely address the net income drop and where every single dollar is going, I promise you. But first, we really need to understand the structural load this company can actually bear by looking at postpaid ARPA, or average revenue per account. Now, this metric measures the average monthly revenue a company earns from each postpaid customer account. Think of it like a massive retail store. The number of people walking through the front doors matters, sure, but what truly dictates the survival of the business is how full their shopping carts are when they finally hit the cash register. In a mature, totally saturated market like US telecom, pretty much everyone already has a smartphone. You can't just rely on adding new humans indefinitely. Rising ARPA is the absolute holy grail. It points to stronger monetization, proving that the long-term durability of their customer base is strengthening, cutting through all that temporary quarterly noise you're worried about.
Now, what's really interesting here is this clear upward trajectory in the numbers. Back in Q1 2025, postpaid ARPA was $146.22. By Q4 2025, it grew to $150.17. And now, hitting Q1 2026, it is pushed up again to $151.93. This brilliantly illustrates that T-Mobile isn't just adding accounts for the sake of sheer volume. They are systematically extracting more value per account.
So how are they doing this? By leveraging their massive 5G network superiority to migrate customers toward higher-margin premium tiers like their Go 5G Next plans. They're bundling in streaming services, they're adding connected devices like smartwatches, and they are convincing entire households to upgrade their plans. They are cementing higher recurring revenues per household, which heavily strengthens their core economics.
And that higher ARP directly translates into some undeniable top-line wins. Total service revenue hit $18.8 billion, up 11%. Postpaid service revenue hit $15.6 billion, up a massive 15%. And even in this incredibly saturated market we talked about, they still bolted on 217,000 new postpaid net accounts. To put that 217,000 number into perspective for a second, stealing that many high-value postpaid accounts away from entrenched competitors like Verizon and AT&T in a single quarter is incredibly difficult. It's a bloodbath out there. So the crucial takeaway here is that a 15% jump in the most reliable recurring revenue stream they have, postpaid service revenue, is the heavy steel reinforcing their entire 2026 financial outlook. Let's move on to Section 2, cracks in the armor, net income and costs.
Okay, I'll admit, the top-line steel looks shiny, but I'm pivoting the conversation right now because we need to forcefully address what is happening at the bottom line. I am not going to let those impressive revenue numbers distract the audience from the financial bleeding we saw earlier. Here's the number that actually matters if you care about real profitability and avoiding capital destruction. Negative 15%. That is the drop in net income down to $2.5 billion year over year. Think about it. You can build the biggest, most beautiful skyscraper in the city, but if it costs you more to maintain the elevators, pay the staff, and fix the plumbing than the actual rent brings in, it's a terrible investment, right? You are just burning money. So I have to press you on this. Is this negative 15% a fundamental structural flaw in T-Mobile's business model, or is it just temporary scaffolding that's eventually going to come down?
It is absolutely temporary scaffolding. Let's break down the specific heavy expenses causing this exact net income drag. You have $476 million in U.S. cellular merger-related costs specifically tied to accelerated depreciation. Then you have $76 million in network restructuring, which, by the way, is literally the cost of physically shutting down redundant cell sites where the legacy networks overlap. And then $141 million in workforce transformation and severance. These are absolutely necessary heavy lifting costs. Absorbing U.S. Cellular gives T-Mobile critical rural spectrum that is incredibly expensive to acquire otherwise. Paying the upfront cash to shut down duplicate towers is short-term pain for massive long-term operational efficiency. They are forging a much stronger network by clearing out the duplication. They are not suffering from permanent leaks in their cash flow. To further defend this foundation, we have to look at the exact metric that seasoned institutional traders actually care about in the telecom sector: core adjusted EBITDA. This measures recurring operating performance by taking earnings and stripping away all those one-time items, unusual charges, interest, taxes, and crucially, non-cash depreciation. Look, telecom requires immense capital expenditures. You are constantly building steel towers and depreciating that equipment over years. That depreciation severely distorts the net income picture. Core adjusted EBITDA is exactly like evaluating the yield of a massive rental property strictly by its regular monthly rent, but only after you completely exclude a massive one-off multi-million-dollar roof repair. It reveals the true, undistorted cash-generating strength of the actual day-to-day business operations.
And when you look at it that way, the comparison is absolutely undeniable. Yes, surface-level net income looks rusted out at $2.5 billion, down 15%, but the core adjusted EBITDA sits at an astounding $9.24 billion, up 11.9% year over year. I really need to emphasize how staggering that is. Achieving nearly 12% EBITDA growth on a massive base of over $9 billion requires sheer operating leverage. While the skeptic here sees surface rust from temporary merger integration costs, the underlying operational engine is actually pumping out record power and industry-leading growth margins. The core is stronger than it has ever been.
All right, Section 3, the heavy lifting, broadband expansion. Fine, the core operations are holding up for now, I'll give you that. But what about the future loads they want to put on this structure? We need to thoroughly examine if their network has the actual structural capacity to support the massive, unprecedented growth they are promising investors over the next few years. They want 15 million 5G broadband customers and around 3.5 million T-Fiber customers by 2030. That is 18 to 19 million total broadband users. I seriously question the feasibility of this. Expanding into home internet and laying physical fiber at this scale requires immense, historically punishing capital expenditures. Are they stretching themselves way too thin and risking a total collapse under their own weight? That is exactly where their fallow capacity model comes into play, and frankly, it's brilliant. They aren't out there building an entirely new wireless network for broadband. Here's how 5G mid-band frequencies actually work. They provide a massive pipe of data. Your average smartphone user driving down the highway barely scratches the surface of that available bandwidth. The towers have excess, unused capacity just sitting there doing absolutely nothing. By offering fixed home internet to customers using this existing, already paid-for grid, that 5G broadband revenue drops almost entirely to the bottom line. The incremental cost to add a home is basically zero. It is an incredibly efficient, high-margin way to monetize assets they already built and paid for.
And regarding the fiber side of things, let's really unpack this mandate from their Capital Markets Day update. Entering the fiber market doesn't mean T-Mobile is out there blindly digging trenches across the entire country. They are utilizing strategic, capital-light joint ventures and partnerships with companies like Lumos and EQT to deploy fiber efficiently. This represents a massive, new load-bearing pillar for the business. It diversifies their revenue streams away from purely wireless smartphone plans and perfectly hedges against wireless saturation. They are actively transforming from just a standard cell phone carrier into a dominant, comprehensive internet service provider that essentially owns the entire household. This is exactly how you future-proof a telecom fortress.
Moving to Section 4, Reinforcing the Fortress, Capital Return.
And what do you do when your fortress is generating record cash and the heavy lifting of the initial network build is finally behind you? You aggressively reward the people who back the construction. Let's meticulously track the massive scaling of capital returned to stockholders here. Back in Q3 2024, they returned $1.4 billion. In Q4 2024, it jumped up to $5.6 billion. Q1 2025 saw $3.4 billion. And now, in Q1 2026, a staggering $6.02 billion. I mentioned the compound effect of buybacks earlier, but it really bears repeating for our listeners. As they systematically buy and retire shares quarter after quarter after quarter, the remaining shareholders own a larger and larger percentage of a highly profitable cash engine. This isn't just growth, this is aggressively reinforcing the fortress walls and directly enriching the shareholders.
Okay, I see the historical data, but look at the reality of what management just did. They literally just increased the 2026 stockholder return authorization by up to $3.6 billion, pushing the massive total authorization to $18.2 billion. I have to ask the hard question here. Is this massive increase a sign of genuine, immense confidence in their future cash flows? Or is it a highly calculated smokescreen to keep retail investors from worrying about those heavy U.S. cellular merger costs and the dropping net income we discussed earlier? Because $18.2 billion is a lot of money to distract people with.
Come on, it is pure, unadulterated confidence. And here is the mathematical proof to back that up. You don't just authorize billions in buybacks out of thin air. You have to generate the hard, cold cash to actually fund them. Methodically step through this raised 2026 guidance with me. Step 1, they raised postpaid account targets to around $1 billion. Step 2, they raised core EBITDA guidance up to an astronomical $37.5 billion. And step 3, which is the absolute most important structural metric of all, they raised adjusted free cash flow guidance to between $18.1 and $18.7 billion. Let's really put that in perspective for a second. $18.7 billion in free cash flow is larger than the entire market capitalization of many established legacy corporations. It's enough cash to outright buy mid-cap S&P 500 companies in cash every single year. You simply do not increase your free cash flow targets to that stratospheric level if your foundation is cracking. The core business isn't just stable, it is accelerating.
Finally, Section 5, the verdict. Opportunity or trap?
All right, we've looked at the blueprints, we've stress-tested the steel, and we've heavily inspected the costs. It's time to synthesize this entire drill down into a definitive iron financial verdict. Let's put all this on the scale for our final stress test. In the pro column, we have surging ARPA and core EBITDA, proving they are monetizing customers better than ever and demonstrating massive operating leverage. We also have those multi-billion-dollar stock buybacks acting as a very solid floor. But over in the con column, we absolutely cannot ignore the heavy, undeniable integration costs of their recent acquisitions, which drove a stark 15% drop in actual net income. This is the exact tension everyday investors are wrestling with right now, the really difficult task of trusting the core operational metrics over the loud negative headline earnings. So is this an ironclad opportunity or just a massive value trap waiting to collapse?
And here is my final authoritative conclusion. The load-bearing pillars hold incredibly strong. Yes, the net income drop looks pretty bad on a superficial level, but as we proved by digging deep into the balance sheet, it is temporary construction dust from aggressively merging U.S. cellular and optimizing those legacy networks. The underlying cash generation, that $9.24 billion in quarterly core EBITDA and the $18 billion plus in raised free cash flow guidance, proves beyond a shadow of a doubt that T-Mobile has built a phenomenally solid foundation. Their 5G moat is unbreached, they are extracting more value per user than ever, and they are returning record capital to shareholders. They are executing their game plan perfectly, making this a highly durable asset for long-term portfolios.
It's a very compelling argument, Lead Analyst. The cash flow is certainly hard to argue with at the end of the day. And it leaves us with one final, provocative question for everyone watching right now. Look closely at your own investments. Is your portfolio built to withstand the broader market noise, or are you getting shaken out of great long-term positions by temporary construction dust? You have to learn to look past the superficial metrics and focus intensely on the structural integrity of the businesses you actually own. Thanks for joining us for this explainer on Iron Financial. Keep testing your convictions, keep inspecting those foundations, and we will absolutely see you on the next drill down.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.